Welcome back to the Personal Finance Project. Today, Scott and Greg will be tackling the beast that is global trade. In the past few months, the topic of tariffs and their impact on the United States' relationship with countries like Canada and China have made headlines daily. We recently did an episode specifically about tariffs for our segment, Things You Pretend to Know, and I highly recommend you take a listen to that episode if you're still trying to understand their impact on the United States economy and your own personal portfolio as an investor. Today, we plan to take an even deeper dive into all things global trade, what it is, the benefits of global trade, as well as the drawbacks and challenges it presents. Scott, where should we begin?
Well, I think before we jump into the nitty-gritty on this one, I was just going to throw out a couple of ideas. As I was recently told, we're allowed to have fun on this podcast.
Lots of fun.
Lots of fun. So I thought what we'd do today to get started was look at a couple things, trivia questions for Greg. So we're going to see if you can nail all of these, then we'll just turn off the podcast because there's nothing else to do.
There is literally no shot that I do that.
Okay. So number one on our global trade trivia quiz is, with what country does the United States have its largest trade surplus?
With what country does the United States have its largest trade surplus? Like, who are we exporting the most of our goods to?
Yes. So the balance of trade, where we have the largest surplus with a country.
I'm going to go with the Great White North. I'm going to go with Canada.
No, so we actually have a deficit with the Great White North.
Nailed it.
So our number one trade surplus partner is the Netherlands.
Okay.
To whom we trade a lot of energy, aircraft.
I was going to say, I thought defense would have overcome the Canadian one, but that makes sense.
Yeah, so energy, aircraft, and computers and technology-related items were the number one things that we send to the Dutch. Apparently, we need to increase our clog and tulip purchases.
Apparently. You know, we just got to watch out for that tulip bulb craze circa 2025.
I was going to say, we can't do that again.
Not again.
Yeah. Okay, so number two, what is the value, and I'll give you like a $20 billion leeway here. What is the value of the goods that pass through the Panama Canal on an annual basis?
Oh my, I have no clue. I don't even have a remote chance of knowing what that is. Why don't you just tell us?
I'm going to just tell you this one. $270 billion.
Pass through the Panama Canal and goods every year?
Pass through the Panama Canal. That is 5% of all maritime trade in the entire world. So
wow,
that kind of like literally 1 out of 20 boats that's moving around in the world is going to go through the Panama Canal on its route.
Okay.
So pretty interesting in my opinion. And then so number three, this is tough, but I feel like you could get at least one of these if you really put your thinking cap
My thinking
on.
cap is firmly affixed.
So let's think about U.S. states and exports as a contributor to their GDP. Which state is the biggest exporter as a percentage of GDP, and which state is the smallest exporter?
Gosh, I want to say something in the oil or automake industry could be up there.
Okay, I'm going to give you a hint. The first part of that is right.
Oil? I'm right on oil? Okay. So I know that particularly during the election, Pennsylvania was a big question on fracking. So Pennsylvania could be an exporter of energy. I obviously know Texas with Permian, huge exporter of energy. But I feel like that's too obvious because we're in Texas. So I don't feel like you would have gone that direction. And I also don't know that whole much about domestic oil or energy production. I'm going to go Pennsylvania.
Okay, you were on the right track. Texas was very, very close. The issue, I think, is we've got too many people.
Oh,
so
right.
Next door neighbor, Louisiana.
Okay.
25.9% of their GDP is exported out of the U.S.
Wow.
So pretty big component.
That is a huge component.
All right. Any guesses on the smallest exporter as percentage of GDP?
Smallest exporter of good. Is it just based on because I want to say it could be like a no-name state up in the Northeast, like Vermont or Rhode Island.
It's not that.
Is it? Oh, man. The smallest exporter of, is it any good in service that they're exporting at all?
Anything at all.
Anything at all. Do the Dakotas do anything still?
Energy.
I guess they still.
At least North Dakota does.
Is it a random state? Would you regard it as a random state?
It's not random. There's a certain thing you go there to do, but I could see you not leaving to do that thing. Think about services, maybe.
California?
Hawaii.
Hawaii. Oh, that makes sense, obviously. Yeah.
They are a state.
They are a state. They still count. They're kind of like Pluto, though. So
Pluto.
How much longer?
Man, are we promoting Hawaii? Yikes. Okay. So with that silly little introduction out of the way, what I thought we would do today, talk just a little bit, we did the tariff episode, and that was actually before Liberation Day,
yes,
if you recall. So we've seen a lot of turbulence in the market since our tariffs episode. So I thought we would dig in just a little bit, talk about what global trade is, which just kind of right off the top, I mean, it's the exchange of goods and services, and we're doing this outside of our countries of origin. So this is not interstate commerce. This is the U.S. buying something from Canada or Mexico or China versus exporting something to the Netherlands, as we just talked about. So that's kind of a general definition. This is this is global commerce, moving things around, logistics, sea lanes, things flying from one country to another.
Goods and services crossing borders.
Yeah, exactly. So no need to belabor that point. We also have both goods, which I think is what everybody thinks about, is these big container ships from China that come over, go through the Panama Canal.
Apparently.
But then they do, as we now know. The other part of that equation is services, which the U.S. tends to be a lot more of an exporter on these types of things, whether it be, consulting, financial planning, or, copyright type of situations with Google or Meta or Amazon, where, as we've talked about on another podcast, the Amazon of Europe tends to be Amazon. They are doing business there, so they are generating revenue that is eventually coming back to the U.S.
Yeah, I mean, the big companies with cloud-based computing services.
Exactly. Yeah. Amazon Web Services, stuff like that. So there's both physical goods, and then there's also intangible services, copyrights, trademarks, things like that.
Intellectual property. Yeah, that kind of
thing. And I would say that as we go on a little bit, a couple of the big players, at least in our current conversation about trade, are these national governments, where you have, the China and the U.S. kind of at a stalemate. We've had a little bit of a kerfuffle, you could say, between Canada, the U.S., and Mexico. Hopefully, we're kind of getting that one smoothed out. And then there's other, there's other contributors here. There's global trade agreements like NAFTA, like the WTO. There's also multinational corporations like,
Amazon,
a Google, a Meta, and Apple, and they've been a big contributor. One of the big conversations recently in the U.S. has been, how much would it cost to build an iPhone in the U.S.? And I think I've seen answers between $3,000 and $30,000, depending on how aggressive you want to be.
Right.
So, I think as we go a little bit further, let's talk first about some of the benefits of global trade, and why one of the things that we hear about a lot lately is trade deficits.
Yes.
And the current administration, I would say, has a very hostile view of trade deficits. And so my first thought is, why? And Greg, why don't you take just a second to kind of tell the listeners why inherently trade deficits are not a bad thing?
Well, I think that when we're talking about trade, and deficits are one thing, is it's kind of a scary word where you feel like you're in a deficit, whereas you have, I think people liken that word to, you are indebted by the same token that you have a trade deficit with some country. It's as if you now owe them something, that because they've given you something and you haven't given them anything in return, you are beneath them in some way. But as the senior advisor on our team likes to say, is for years and years and years and years, we've gotten cheap goods from places like China. And in return for those cheap goods, we've returned to them slips of paper, which are the United States dollar. And the thing that we were just talking about off air is, if you were to analyze your trade deficit with Costco, as an example, my trade deficit with Costco is irreparably negative. There is no amount of money at this point in time that Costco could send me in order to rebalance that trade. The balance of trade is always going to be a deficit. But from my perspective, I'm not stressed about that arrangement. And it does seem like a silly example because it's such a micro level way of looking at it. But if you just blow this up to a global scale and we remove the complicating factor of politics, where the goods are coming from the thems, so to speak, it's coming from over there, it's the same arrangement. It's they are producing goods and services that we want to buy, and we are buying them as cheap as we possibly can. And I think Adam Smith, when you used to have these trades that were in gold, the gold supply of a country was something that often measured their wealth. But his perspective was the gold supply in a country is really secondary to the services that could be purchased with that gold. And if you can purchase more services with your gold, you are by nature wealthier than you were before. And in his view, and in my view, and in the view of many economists between him and now, they took the same position, was it doesn't really matter where the good or service is coming from. The consumer is always made better off by being able to purchase it at the lowest possible price. So I think when we're talking about a trade deficit, and we can look at the periods of time where we've had trade surpluses, they were not happy times in the United States. They were unhappy times, as it turns out. Our economy was no better off. In fact, in many cases, it was much worse off when we had trade surpluses than when we had trade deficits. So I think that semantically, deficits just kind of got a negative connotation.
So I'm going to give credit to the Hoover Institution on this point, because I think it makes quite a bit of sense. Going back to the point you made, Greg, where you said they're sending us services and we're sending them little slips of paper that cost very, very little to generate. If you think about over time, what you'd really like for them to do with those little pieces of paper is just keep them, because the other option is that they are now buying a service from, say, the U.S. government in the form of treasury bonds. Mm-hmm. That's the conversation that people have a lot about the debt, basically, is that, okay, China is sending us all this stuff. We're sending them all this money. They own such a huge portion of our debt. That could be problematic, and I think there's an argument to be made there. But the other thing that you can do with those little slips of paper is you can reinvest in the U.S. economy, which you could probably go either direction on the benefits or the drawback to here. One is that U.S. companies and U.S. corporations, people are getting the capital infusion of foreign dollars from profit flowing into our country. The maybe negative that you could take away from that is, do we over time lose a little bit of our country to foreign investment? That's something that, it's a little bit tough to track, frankly, because of trusts and the investment of foreign companies into U.S. products. There's a big debate about TikTok right now. But I think generally, if you think about where the average is, the average wealth of a U.S. household is going up. You could maybe make a less strong argument about the median and how the influence of foreign money into the U.S. could be holding the median back just a little bit.
It could. And I think there are certainly a lot of U-shaped curves out there where you get a little bit more, you get a little bit of benefit, but you get too much and it can be fatal. That's true in medicine. It's true in a lot of businesses where you want to make sure. Tax rates is another one, popularized as the Laffer curve, where you increase tax rates a little bit, you get more revenues to the treasury, you increase them too much, and people are basically like, okay, I'm going to move. I'm not paying tax rates that high. So I think that when it comes to these arrangements where we have some foreign investment in the United States, that might be a positive. But when we're talking about, I think a couple of years ago, there was the dust up about how much farmland the Chinese were buying. And it's like, well, what are they buying that with? We're buying that with all those slips of paper that we sent with them after we exchanged it for shoes.
Well, and then they're using the bonds that they bought with the slips of paper as collateral for the land. It's kind of this vicious cycle, you could say, where they're continuing to get a bigger and bigger piece of our pie.
So I think when we're talking about the uses and abuses of foreign trade, there are certain nuances where people could make a strong case for some barriers. But I think that generally speaking, the example that we went to before, the grocery example, the Hoover Institute used Safeway, because we were talking about how we thought that this was just a phenomenal example. I think when we're talking about how goods and services are flowing, not just, obviously in my example, goods are flowing from Costco to me, and from me, dollars are going back to Costco, and they're never going to reverse that arrangement. I'm made better off, Costco's made better off. And that's how trade generally works, is if you were a seller of newspapers and I'm a buyer, I'm not going to buy a newspaper from you for $1 that I think is only worth 50 cents because it's not a product that I rely on. And so I'm going to buy the newspaper from you at the lowest possible price, and we don't need a third party to tell us, nope, actually you need to pay an excise tax because this is coming from Scott Bartosh and it's not coming from another Ashcroft. They're outside of your nuclear family, so you got to pay a tax on that.
The old family tariff.
Right. And so at the very localized level, people tend to grasp this quite quickly. And then even in intrastate commerce or interstate commerce. It's like if we can grow things more productively in Nebraska than we can in, say, the Pacific Northwest, people in the Pacific Northwest aren't that bothered by the fact that their corn was grown in Nebraska.
Yeah, you're not going to start up a cornfield in Washington State when it's so much more efficient to do so in Nebraska or Iowa.
A lot of global trade has arisen out of pure chance, whereas coffee is another example. The conditions beneath which coffee need to be grown are very particular. And yes, maybe with the advent of, I think they call them vertical farms or other such things, this might be a problem of the past when AI kind of takes over and we can have all these really interesting stuff. But right now, the climatic conditions required to grow coffee efficiently are such that only a handful of countries do so. And virtually all of the exports of coffee, at least in a bygone era, came out of like 4 or 5 countries.
Yeah.
And it wasn't because these people had any unusual capacity to grow coffee. It's because of conditions that were found only in those places. And so the point that economists have been making for years and years and years now is not being able to trade for that coffee based on the fact that it was being grown in Brazil is fundamentally backwards, because it raises the price of that artificially. And then to tariff it would be even more unusual because it's not like we had the capacity to create our coffee here in the United States. We just don't have the conditions.
Yeah, it's kind of, if you go back in time, let's say to the 1600s, and like a huge portion of, exploration by the West was to find some of this stuff that only grows in 1 or 2 places, like cinnamon and nutmeg and cloves, which I think there's a couple of islands in the Moluccas or in Indonesia that can actually grow these things.
Exactly. And then you think back to some of the tragedies of the past, like the Irish potato famine. It's like, well, the Irish haven't been growing their own food for many, many years now, and like large swaths of it. And you can see why. Because if you have a condition where all of a sudden you can no longer grow your food in your country, that could be dire for very many people. But free trade, where places can produce food extremely efficiently and ship it very cheaply to the United States, it's like Great Britain hasn't produced its own food in centuries because it's not a particularly hospitable place for them to grow all of the food they would need in order to feed their growing population. So they have to import it from elsewhere, and they generally export services, but they're importers of commodities. This is the way that very prosperous nations have tended to move as time goes on, and it makes a whole lot of sense.
Yeah, it does, and I think that kind of leads to the next question. And we touched a little bit on this one in the tariffs episode, but one of the other challenges I think with the current setup of global trade is that, one of the words that they like to talk about, people used to say the first world, second and third world. Now they say that, the global south, as like countries that are less developed, is the current system preventing some of those countries from joining the global north? I'm not here to make a determination on that today, but if we look at, I believe the third biggest importer to the U.S. is Vietnam. And the working conditions in Vietnam, not what they are in Houston, Texas. And whether you're building an iPhone or a T-shirt, whatever it might be, that person in Vietnam is not being compensated on the same scale, obviously in a different currency. So there's a lot of barriers to entry for us to even think about competing with Vietnam, say making T-shirts or jeans.
Sure. And I think that there are some ways where we're going to be able to assuage that, because people can often confuse wage rates with labor costs, where it's like wage rate is what people in the United States, people in Vietnam are paid per hour. But a labor cost would be what they're paid per output of good that they produce. And so there is a bit of a fallacy thinking, well, okay, why aren't all jobs outsourced to India where we can pay them 15% of what we pay a person in the United States or 20% of what we pay a person in the United States? It's because they lack infrastructure and technology, those workers, though you can pay them far less than what you would pay a worker in the United States, they're much less efficient. And so we have an efficiency question here in the United States where some of the commodities can still be produced more efficiently in the global south. But that won't always be true, because with augmented intelligence or the AI as a precursor to AI, I think that workers in the United States could get so efficient that you can pay them a decent wage by United States standards. And yet the labor costs, or what we're paying them per output of good, or however much they can produce in a given day, we're going to be able to drive that number down, down, down.
Yeah, I mean, that's the scenario where you're not making the t-shirt, a machine is making the t-shirt, and you're making sure that the machine keeps making t-shirts.
Exactly. Or the machine is taking over a very labor intensive, we talked about this off air. If we can spare workers jobs that have maimed them historically, like aluminum workers, for example, handling 1500 degree metal, if we can spare them the most dangerous parts of their job, and so we have fewer workers who we're paying workman's comp claims to, you can imagine how inefficient that arrangement is.
Yeah.
United States, if a person not working, you've had to train a replacement, but you're paying out, what is it, like 60% of their salary every year? Mm-hmm. So that makes the cost per good produced go up. And it can sometimes be dramatic, particularly if you're getting, workers injured all the time. So there are some efficiency moves that we're going to be making in the United States leveraging AI, and that will certainly accrue. Those benefits will accrue to the more prosperous countries first, and it will trickle down. But I think that can be a confusing point for people to say, well, we can just pay people so cheaply there. It's like, yeah, but if the roads aren't good, if the machines aren't good, if the capital investment hasn't been made in order to make those workers efficient, we can still kind of solve for that in the United States. And I think that probably is what we're going to see.
Yeah, I think you're right. So changing gears just a little bit, what I thought we would kind of talk a little bit more on the tariff situation, because one of the things that I think people, since the Liberation Day conversation and these reciprocal tariffs have been announced, I think one of the things that people, and the media has been especially not very good at this, is that tariffs happen completely in a vacuum, and that, say you were buying, milk from Canada and you were paying $2 a gallon, and there's 100% tariff on milk from Canada. Now you're paying $4. One of the things that, and I think that Mr. Trump is right in talking about this as a negotiation, is that assume that tariff stayed forever. So we're just going to, in a vacuum, say that all of these tariffs and reciprocal tariffs come back after this 90-day pause that is now in effect. Mm-hmm. What you would probably see on the other side of it is that if these Canadian producers of milk wanted to continue to send it to the U.S., they would be forced to charge a little bit less, so that then after the tariff is added on, the final product is probably more, which would be passed on to the end consumer in the U.S., but not a full 100% higher. So if we think about this, going back to this example I'm describing, $2 for a gallon of milk, we take that down to $1.40, add that 100% tariff on it. The price of milk has gone up now, not 100%, but 40%.
Yeah.
Still quite a bit.
A lot.
Definitely a lot. But if you think about that through the broader spectrum, it's a little bit less dramatic than the way that the tariffs are described.
Yeah, and I think that really gets at another topic we've talked about, which is in putting tariffs on as essentially lighting a fire underneath innovation. Because if you think about the Canadians and the production of milk, it's like, well, the tariff itself didn't suddenly make them more innovative. But the threat of the tariff, and maybe this is what Donald Trump is doing, is saying, look, guys, produce your milk more cheaply, figure it out. And if they can produce their milk more cheaply, charge less for it, still retain some profit on the sale, they have to in order to make that a viable business, well, then I think ultimately you can find a situation where everybody is made incrementally better off. Now, my argument would be if countries get so efficient at producing milk, then it's possible that the tariff becomes totally irrelevant because the price of milk has gone down so much that why? Because if they can produce it so much more cheaply now based on the tariff, or you've put this tariff on and we innovated in the United States saying, guys, these reciprocal tariffs are going to go into effect again, get more efficient at producing milk here, maybe that works. And I think that really what can happen though is you take the medicine, but you might not like how it tastes. And so I worry that maybe you put on tariffs, the innovation takes off, and we do lose jobs in the very sectors that maybe we're trying to protect with the tariffs, because corporations are clever. They're going to figure out how to be competitive on the global scale, and often that means reducing labor costs right away. And so you might see more and more products being made by more and more machines in an effort to drive down the prices, not artificially, but so that they can be competitive even with the imposition of a tariff.
I think the other strategy that could come to pass out of this, and I've seen a couple people pose this, is that maybe if we keep our tariffs stubbornly high, a potential solution could be to bring the opposing tariff to zero, and lean into imbalancing, say, that trade deficit that we have, not for our benefit, but for theirs.
Right.
Because if we are going to now be able to send them cheap goods, because as we've talked about a little bit, the dollar has gone down in price a little bit as people have been a little spooked by the turbulence in the market caused by the last couple of months. Say we now are willing to send some of the innovative stuff that we make in terms of, aircraft parts and machine parts that require a great deal of specialization that we're actually really good at producing. And say the Netherlands says, all right, we'll take you up on that. We'll buy a whole bunch of machine parts really cheap, and we're not going to charge a tariff on them at all.
Yeah. And I think that ultimately could make some sense. Now, if tariffs are come up and then they go away, I think the protective tariff has been one. We got into this last time.
Yeah.
Really great for the sugar business, terrible for the confectioners because their costs internally went up dramatically. And they're like, oh, shoot, with sugar being as expensive as it is, I can't really afford it. So I think that if the argument is we have this budding industry, we want to get it off the ground, but it can't get off the ground because it can't compete on a global scale because other countries are far more efficient at doing the exact same thing. I think that there are two minds. Is it worthwhile to be able to produce that good in the United States? And is there a case that exceeds or that transcends pure economic theory, where, as we saw during COVID, is redundancy, being able to produce goods and services that we need in the event that global supply chains were to shut down? We thought it was in the unlikely event, but we all lived through it. Well, I suppose all of our listeners lived through it. Unless you are very young. We saw
started early on the
financial planning podcasts. I think all of a sudden people saw that just-in-time inventory management wasn't as infallible as economic theory would have stipulated that it was. It's something that a consultant can come to you and say, here's a really interesting way to boost your profits. It's called just-in-time inventory management, where boom, literally it is as it sounds. Good comes in, goes to the buyer.
Immediately goes out.
Immediately goes to the buyer. So warehouse capacity, redundancy, those things were reduced, but those costs are not insignificant to ensure products that are just sitting on your shelves. That is a significant piece of doing business. But I think we all learned, particularly when, for whatever the reason, for an upper respiratory virus, we couldn't find toilet paper. You would have thought it was cholera going around and not COVID.
It wasn't dysentery either.
It wasn't dysentery either, and thank God for that. But we soon discovered that we are very reliant on global supply chains.
Yeah, and I think the two arguments, and going back to this Hoover piece that we've been referencing a couple of times, the two arguments that they make where you could kind of really defend tariffs in the global trade argument would be, one, as a national defense measure,
for sure,
where you need that good produced here so that it can't be basically held over your head in a conflict, potentially. Say every single microchip comes from Taiwan. China invades Taiwan. We have no access to microchips.
Exactly.
And we're completely beholden to them.
Mm-hmm.
So that's one example. And then the other two, which I think is interesting and also not really being discussed in the media, is we tax a heck of a lot of things. We tax income, we tax energy, we tax tobacco, we tax property ownership, sales of everything, sales tax. Is there a reasonable argument to be made? Well, tariffs are part of that. And so maybe we bring down other taxes slightly and have a little bit of a tariff on various goods and services, and the general overall tax picture is about equal.
Yeah. I mean, I think that there are many instances where you can get the same result, but it can feel a lot better. So for whatever the reason, we counsel clients on this all the time. Some people prefer to get a big refund in April or whenever they file their taxes. And because for them, that's a far less painful scenario than having had the money, earned the interest and dividends on that money, and then paying out a big check when they actually filed their taxes. So they're essentially to the Treasury, same result, but feels entirely different to the person actually paying the tax. So I think in our work, we try to get it to basically zero, where you don't get a refund, but you don't have to pay anything. We see that as maybe slightly suboptimal, but experientially something our clients can very much palate. And so I think you're right. If this is just baked into the overall pie, I'd be curious to see, and whether or not we're going to get good data on this, it's going to take some years.
Yeah.
Where flows to the Treasury go based on the imposition of a tariff, and if we get any reciprocal declines in other taxes. I know that there's been some speculation about, there was brief speculation about no income tax, just gone. And I think, I wouldn't hold your breath.
Yeah.
You're going to be holding it, unless you're David Blaine, then maybe,
you can do it for a long time. So, but yeah, if we're talking about this as coming down, some other tax declining a little bit because we're going to have this tariff in place, that I think could make sense in the long term. But the other thing that I think is just so obvious to anybody who's seriously looking at these questions is, if you really want to solve the question of too many of those pieces of paper currency going out of the U.S., the real question is, we need to spend less money as opposed to we need to raise revenue.
Right.
Because raising revenue, as you talked about with the Laffer curve, there's a point, whether it's through tariffs or some other tax, there's a point where consumption and spending and efficiency or productivity just really decline by a lot.
When we're talking about how there are sensible arguments in favor of tariffs, I like the national defense and the planned redundancy. I like this sort of behavioral economics stance that they might take and say, well, we might not actually reduce revenues to the Treasury if we can lighten the load of taxes elsewhere. But I think it is worth saying, when NAFTA came into, I think it was 1973, when that was passed, the headlines back then were, you're going to hear a sucking noise and it's going to be jobs leaving the United States and going to Mexico.
Mm-hmm.
But then when these things had been in place for a few years, they examined job growth, both the United States, Mexico, and Canada, and found unemployment had declined. So employment had increased. Jobs were created in the United States, jobs were created in Mexico, jobs were created in Canada. Now, the nature of those jobs were different in all three places based on the things that those countries were well suited to do. And I don't mean to beat the dead horse here, but when you are taking your macroeconomics class in college, the first 3 or 4 things you learn are absolute advantages, comparative advantages, economies of scale, and opportunity costs. And these things are, I wouldn't say they're like laws of physics, but they're unimpeachable and almost irrefutable. Where if you have a country that has a comparative advantage, and I think one of the quotes I read was, there is a place for every country under the free trade sun, because it's certain that they can produce one good more efficiently than some other country.
Yeah.
And so I think that that's what we've discovered time and again. I think the Smoot-Hawley tariffs are kind of like people's first introduction to what those did. This could be speculation, but a lot of people think that the depression was prolonged as a consequence of those tariffs rather than alleviated as a consequence of those tariffs. So I think that, yes, the Hoover Institute is making some arguments in favor of tariffs that are very interesting and, frankly, I think worth considering. But I do have a difficult time removing myself from the history of tariffs and the effects that they've had on the economy, not just in the country who's imposing them, but even on our trade counterpart. George Mack, who is a guy, we talked about him briefly. He's quasi-famous in certain circles for his midwit memes, which is like super low IQ guy, super high IQ guy. Those guys tend to come to the same conclusion. And then there's the midwit guy who tends to really overcomplicate things.
Yeah.
So at his point, George Mack said, a guy who I don't think is a midwit, probably a high IQ guy, he wanted to create his own sandwich from scratch. He wanted to grow the wheat, mill the wheat, get the flour, bake the bread, grow the vegetables, grow the meat for the sandwich. And it took an unbelievable amount of time. And I think the ultimate price of the sandwich all in was like $1,500. And it was not very good. And so when we look at that, when we look at these highly stylized examples or examples that are meant to be extreme, they often do have an embedded point, which is like, I think the one more people are familiar with, which is the story of the pencil, right? Where the wood comes from, where the graphite comes from, where the aluminum comes from, where the rubber for the eraser comes from, and that it would be virtually impossible for any company to develop enough economy of scale to create every piece of a very simple, number 2 Ticonderoga pencil, or in this guy's case, one sandwich, to make it a viable business. And so at the local level, we all understand this. I favored the listener with my example on I stole it from you. My trade balance with Costco is irreparably negative, and I'm perfectly okay with that arrangement.
You know what? Baird's trade balance with us is irreparably negative.
Irreparably negative.
We're never going to pay them.
And I think that they're okay with that arrangement because of the
are.
productive capacity that we have. So I think that when we are talking about global trade, and particularly with the current election or with the current political environment that we find ourselves in, these things can get needlessly politicized. And I think if we can take a bit of an agnostic point of view and just try to recognize the benefits of trade and then remove the word global from the vernacular, if you just talk trade, a lot of people immediately kind of recognize the benefits there.
Yeah, and I think I literally just wrote down complexity because I think that's why maybe we're having trouble finding a perfect way to wrap this episode, because going back to the Panama Canal example, I mean, that's that 5% number means that there's $5 trillion of stuff moving around on boats across this blue orb that we're on. You brought up earlier in terms of efficiency, if we could do intergalactic trade,
right?
We would,
yeah,
because it would improve our situation in the world or in the galaxy, so to speak, if we could do that kind of trade. So this is an extremely difficult question to answer, and I think we've tried to touch on some of the reasons why it's complicated, why we're going to probably continue to talk about this, and maybe have a part 3 to this tariff global trade discussion.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.